I'm Stacey West from Chelsea, and today I've been joined by Darius and Juliet to get an update on the VT Chelsea managed range of funds. Now, before we start, I should just point out that we'll be discussing some individual stocks and investments to illustrate how the Chelsea funds have been positioned, and anyone watching this video shouldn't see this as a recommendation to buy or sell these stocks. It's just to paint a picture. So there are 4 funds in the range. Can you briefly tell us a little bit about each?
Yes, hi. So there are 4 funds, as you say, and they were designed for different types of investor. If I start with a fund that takes the least amount of risk, that's the VT Chelsea Managed Cautious Growth Fund. Then there's the Chelsea Managed Balanced Growth and VT Chelsea Managed Aggressive Growth. Then for those investors who are looking to generate an income, there's the VT Chelsea Managed Monthly Income Fund. Each contains a mix of investments selected by our expert team. You simply choose which fund is right for you and leave the rest to us.
And the funds were launched just over 4 years ago now. How have they done?
The first thing I'd like to say is a big thanks to all our clients who bought the funds at launch and subsequently. I am delighted to say all 4 funds have gone down really well. The Aggressive Fund is up 63% versus the IA Global Sector average of 57%. The Balance Fund is up 43% versus IA Mixed 40-85 sector of average of 28%. And the Cautious Fund is up 27% and the Monthly Income Fund up 35%, both versus the IA Mixed Investment 2060 sector average of 19%. So all of the 4 funds are ahead of their peer groups since launch. What's more, Balanced is in the top decile, and Monthly Income and Cautious are top quartile, and Aggressive is in the middle of the second quartile. The fund range also won a Lipper Award for small multi-asset managers, which was totally unexpected.
And what's worked well?
I think part of it is that the investment advisor team has got very different skill sets and points of view, which does help with making investment choices. Macroeconomics are very hotly debated, and there is a lot of in-depth research undertaken, which I think has stood funds in good stead. On aggregate, it is the underlying fund picks that have worked so well, particularly in geographies like Asia and Europe. Some of the investment trust picks have also done very well too. To give you a couple of examples where the range has made a huge amount of money, for instance, the Chrysalis Investment Company, that trust is up over 150% since the fund range invested in it. Another example is the Lindsell Train Investment Trust, which also did very well when we owned it, but we no longer do. Other investments which have done well are gold and silver. They actually performed very poorly for the first 3 years, and in 2020 sort of were up 70-80% in very short order. So staying positive on things which haven't done well has also helped.
And just thinking about what hasn't gone so well, you mentioned that the gold allocation earlier on in the life of the fund hurt performance. Was there anything else that didn't work as well?
I think the main thing was being underweight the US, which is such a large part of the global benchmark. US equities were expensive when the funds launched, but as you know, things can just get more expensive, and the US has continued to outperform. So I'm just very pleased that the funds have done really very well despite that underweight.
And what's been the most hotly debated topic amongst the investment advisors?
Well, the simple answer is gold and silver. It's actually only somewhere between 2 and 4% allocation in the funds, but it's one where the investment advisor has been split 50-50, with 2 of us being gold bugs and 2 being gold bears. And the gold bears were right for the first 3 years. Then all of a sudden, in a very short period of time, our gold position was up 40% and our silver position was up 130% in just a few months last year. So that's definitely been a hotly debated topic, as has the allocation to fixed income. The Cautious Fund had no fixed income in the vast majority of its lifetime, given that valuation in fixed income markets have remained high. India versus China is another area which has been hotly debated during the period. The team actually agrees that India has probably the better long-term prospects, but for the majority of the time, actually China outperformed. Then there's the value versus growth conundrum. The funds retain some value strategies in the portfolio despite their relative underperformance versus growth. And actually, that has helped the funds continue to perform well in the last 6 to 9 months, where value funds have actually benefited from the vaccine bounce and reopening of economies.
And how are the funds positioned today?
The funds remain quite balanced. Equities and bonds both still look expensive on any long-term relative valuation metric. There are some value strategies in the portfolios which really have helped since the vaccine announcements in late November last year. And the big debate today is around inflation. How high will it go, and for how long will it remain higher? The funds have recently invested in a shipping investment trust that buys ships and leases them out. And the rate that they can charge has gone through the roof in the past couple of months. In fact, the investment is up 23.9% already. There is also some inflation linking in some of the other investment trust holdings, but actually just holding some value funds, which have done better in the inflationary period, helps in this respect too. The macroeconomic picture is very difficult to call at the moment. We're hopefully breaking the back of the pandemic now, but there are still lots of unknowns out there, and maintaining balance is key. So that's where the funds are at the moment.
Does that mean that the funds don't have a big overweight or underweight to any particular region or sector?
Well, the area that the funds have added to most this year is actually the UK market. With it being clear that the UK was going to be ahead of the curve with respect to vaccine rollout, Brexit, whatever your view, at least being behind us, at least the politics of it, it seemed that that might be a catalyst for UK outperforming this year. The other sector the funds have been adding to is technology. Technology normally looks expensive, but we've been buying the Polar Capital Technology Investment Trust, which actually trades at a discount, even though it's in such a popular sector. And what we've seen on earnings coming from some of these companies like Amazon and Apple have been spectacular. So when you look at it, things on a PE basis, actually the earnings have been totally delivering, which I think means that the PE ratios don't look as high as they may do on paper.
Darius, Juliet, thank you very much for your time today. And if you'd like to find out more about the VT Chelsea managed range of funds, please go to chelseafs.co.uk.